This is problem 19 from Chapter 2 of the CFA Institute textbook, Corporate Finance, A Practical Approach, 2nd edition. This is walking you through an entire capital budgeting problem, a project analysis. Fitco is talking about buying some equipment which costs $350,000 and another $110,000 to install it. So to get it up and running, it'll be $460,000, and that's the depreciable base. They're going to depreciate it over 5 years from 460 down to 0. So if you divide 460 by 5, that'll be the annual depreciation expense. Going to generate revenue each year of $265, has additional expenses of $83,000 plus the depreciation expenses. You could sell the equipment at the end of 5 years for $85,000. When you sell it, there will be a taxable event because you're selling a piece of equipment that you've depreciated to 0 and you're selling it for $85,000. It means you took too much depreciation. There's also an inventory investment at time 0 is $73,000. You have to buy $73,000 of additional what have you. Either it's accounts receivable or it's additional inventory, but whatever. Over the life of the project, you're going to have to keep $73,000. So at time 0, you buy all of that stuff, and at the end of the year 5, you sell it off, so you recover it. Got a 40% tax bracket, a 10% cost of capital. Calculate the project's NPV. I set these up using timelines, and I just systematically go through here and list out everything I see and put the cash flow where it belongs. I also label everything so I'll remember what it was. The equipment cost is a negative $350,000 because it's an outflow. Installation is negative $110,000. Okay? So that's $460,000 before we get started. It's going to be depreciated over a 5-year life, so the depreciation expenses, I'm going to put those down here, depreciation expense in year 1 would be the absolute value of the sum of those two numbers, which is $460,000 divided by 5. So $92,000 each year over the course of the 5 years. That'd be my $460,000 depreciation expense. All right, but it's not a cash flow. It does reduce income taxes, and so that will help. My revenue, the marginal revenue, is $265,000 each year. And the cash expenses are $83,000 each year, which means that my pre-tax marginal profit from an accounting standpoint is going to be about $90,000 a year. Now that's accounting profit because I need that because the taxes, which are 40%, are based on accounting profits. So that'll give me the after-tax profit each year of $54,000. Okay, now we do cash flows because we're finance wizards, so the after-tax operating cash flows are simply the after-tax profit and add back the depreciation expense. And that's a cash flow. It means the checking account gets $146,000 fatter each year. These two are cash flows because I actually have to spend that money at time zero. Alright, now the equipment's going to cost $460, but I'm going to sell the equipment for $85,000 at the end of the period, and that's a positive cash flow, but I'm going to owe income taxes because I depreciated this to zero, but I really should have depreciated it down to $85,000. So the taxes would be 40% of $80,000. All right. Now enter that as a negative because it's a cash outflow. And then the only other thing is the inventory investment, which is a cash flow at time zero, which is $73,000. And that means I got to buy that. But the good news is that at the end of the project, I'll sell off all the inventory with it, and that'll be a positive cash flow. Okay, so make sure I got all my cash flows. I got my depreciation factored in here. I got my revenue, my cash expenses. Use those to cash after-tax cash flows. I got my terminal cash flows here and my initial investments over here. I have accounted for everything. So if I add together all the yellow numbers, those are the cash flows. And now if I'm calculating the NPV, the weighted average cost of capital, or my discount rate is 10%, and that's given in the problem up here. The cost of capital is 10%. The present value of the future cash flows, NPV at 10%, and that's the cash flows from period 1 through 5. The present value of those is $630,000 and change. The initial outlay is the $533. So my NPV would be the sum of those two numbers, all right? Or the net future, the value of the future cash flows, net of the value of the initial outlays. And the answer is $97,449. We don't usually show pennies on here, so to make it look nice, there's my answer. Those are typical test questions.